This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our webpage, stltest.net. You'll see various services that we offer, including the books, the blog. CPA Exam for Dummies book comes out in September of 2014, the blog, the podcast, and also the tutoring services that we offer here and all the video links. I want to cover a problem using an example I got from a student that links together assumptions about sales, production, and takes those numbers and puts them in the income statement. And this is all on a linked Excel document. You can email me if you'd like to get this linked Excel spreadsheet. I'm not sure if I'll get through all of this in one video, probably not. I may have to do a second. So the company's Cooking Incorporated, and they make cookers and smokers. We're given a retail price, $130 each. We're told there's a certain amount of raw material that the company uses to make the product at $8 per ounce. The company wants to maintain an ending stock of raw material equal to 10% of production for the current month. These numbers are important to go over kind of up front. And the company would like to maintain an ending stock of finished goods of 20% of next month's sales. Now you'll note the difference between the percentage of ending raw materials they want, 10% of the current month, and ending fixed goods that they want in blue, 20% of the next month. So you've got to be careful with the percentages and whether it's the current month or the next month. We're given sales. We're told how many cokers they're going to sell in April, how much direct material they'll need for April. We're then told that when we collect cash, 15% will be cash sales, 85% on account. Now, I didn't like the way that this information was laid out because direct labor was included as an operating expense. Normally, direct material and direct labor would be a direct cost and cost of goods sold. We'll see at the end of this problem that direct labor is part of operating expenses. I don't think that's correct, but I left it that way so I could do the problem for the student. We're told about, in terms of direct labor, or how much of an hour it takes to make a unit and what our rate is, the rate that we pay for labor. No interest expense. We're given an income tax budget of 35% on income. So the first thing we do in step one here is prepare a sales budget. We're given unit sales per month, a selling price per month. We multiply and we come up with sales revenue. Then what I did was I said off to the right, 15% of sales are cash, 85% are credit. So for example, if I click on the March sales, 15% of the March sales, 1.8 million roughly, that's the portion I get in cash, 273. 85% of the March sales, 1,820,000, 1,547,000 is what is a receivable. So 273 cash, 1547 a receivable, totaling the 1,820,000 that agrees to the sales number right here. So we did that for all the months. So that is our sales budget. Sales budget. Now that we know how much we plan on selling, we can plan our production. So here's our expected sales tied in from the chart above. The company wants 20% of next month's sales in ending inventory. So when you open your doors on the first day of the month, you have some goods to sell. So January is 20% of February. Goes on across. February is 20% of March. March is 20% of April. I get the total number of units I need. I subtract out what I already have in ending inventory. Now this is a little tricky because beginning inventory is a certain percentage of the prior month's agrees to, I should say, prior month's ending inventory. So January is ending December. which I just plugged in at 2,000. February is ending January. March beginning inventory is ending February, and it goes all the way across. And so I have a formula in here where I come up with the units I need to make, units to produce. Once I know the production, I can then go on and think about how much material do I need to make my units. So, units to produce from the chart just above. Ounces per unit that I'm making, I was given that in the problem at the top. I multiply to get total ounces I need for production. We're told in the detail of the question that we want an ending inventory of materials, not units. An ending inventory of materials of 10% of the current month's production. So these numbers are simply 10% of the numbers above, 10% of the production. We add that up and we get the total ounces of stuff that we need. And we subtract ending inventory of direct material, beginning inventory, of direct materials, which is ending inventory for the prior month. So for February, the beginning inventory for February is ending January. Beginning inventory for March is ending February. That can be a little tricky. I add that all up. I get ounces I need to purchase. Go out there and purchase material. I have a cost of $8 an ounce, and I get my total cost of direct material. Now this problem switches gears because it goes on to talk about budgeted manufacturing costs per unit. So I highlighted cost per unit, and this is just for 1 month, January, not the whole quarter. So my direct material 88, I've already figured out right here. It's 11 ounces times the cost of $8 an ounce. That's how I get my 88. My direct labor costs a quarter of an hour to make a unit times a 15% labor rate. That's how I get my labor. Now my variable overhead, this is tricky too. I was given my total variable overhead in dollars up here at the top. Way at the top. You notice I'm given variable and fixed overhead here at the top. I'm just looking at January. So what I did here was to take total variable overhead in dollars divided by units produced to get $3. Now for fixed overhead, this is a warning. I'm asked for a per unit amount. However, you got to be cautious of looking at fixed overhead per unit because there's only a fixed dollar amount by definition, and at some point you've paid all your fixed overhead and you don't need to apply it to any more units because you've already covered it all. So some units will be produced without any fixed overhead because you've already covered it. But in any case, I took the fixed overhead in dollars, which we're told at the top is $41,000. And I took that and I divided the $41,000 by the units produced here to come up with $427. I have a total manufacturing cost for each item, $99.02. So I wrap up here at the bottom by coming up with a budgeted income statement. The sales revenues was right from the top. And again, here's where it's tricky also because cost of goods sold only represents direct material. So I'm multiplying 101 here, the cell in 101, which is the $88, by number of units sold. So if I click on here and I go up to the top and I go up to the cell to explain, here were my unit sales 6,000, and I'm multiplying those by the 88 to get to the 528,000. Again, direct labor should be in this cost of goods sold number. Instead, it's down here. Gross profit is the difference between sales revenue and cost of goods sold. Then we get to the operating expenses. Now, again, I disagree, but just to keep it straight, this company included labor and all overhead in operating expenses. So if I go down to the bottom, I say for this problem, operating expenses is direct labor and overhead. And I did a little chart off to the side where I added up the direct labor and the overhead that we figured out up here, these numbers, and I added the three of them up to come up with the 1102. So I multiply the 1102 by the units that we sold. I come up with an operating income, gross profit in blue less operating expenses in green. There's no interest expense. I multiply the net income in blue times 35% to get my income tax expense, and I get my net income. So what we did in this problem was, to sort of sum it up, because this is a lot to throw at you, we have a sales budget, and if we know how much we sold, we get a production budget. And if we know how much we're going to produce, we know how much direct material we need to buy. And if we know that, we can calculate our total cost per unit, and that's going to allow us to create a budgeted income statement. That's as far as we'll get for now. Remember, on the website, stltest.net, we have all the books, the dummies books, including the CPA exam for dummies, out in September 2014. The blog, the podcast, Accounting Accidentally, tutoring services here, and links to all of our videos. Thanks very much for watching, and we'll see you next time.